Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We had the most devastatingly terrible data out of the US overnight, but of course the US stock market continued to rally. So the devastating data was the New York Empire State Index, which fell really precipitously, suggesting a very sharp manufacturing slowdown in actual output and new orders going forward. All of this data that we're seeing, and it came on top of the data obviously earlier in the day, where China's fixed investment, retail sales, etc., and property prices there were all very disappointing indeed. In fact, the property prices in China yesterday fell the most they have in several years. So nothing but dire economic outlook, but of course stocks continue to rally. And what we have at the moment, I think, is my lack of appreciation of just how young the new funds management industry is. They seem to have reduced everything to a binary situation. So in other words, they feel it's as if the broad market, and let's face it, the funds management industry, they are the elephants in the room. They are the freight trains. If they're all going in one direction, it doesn't really matter what's happening on the economic front. From my own point of view, I've called the economic situation perfectly, but not the stock market. I've called the stock market perfectly for the first half of the year, but certainly not this month or in July. So I'm still looking to sell the rally, so I'm trying to explain that. Basically, what we've got is, I think, a funds management industry and also, of course, all the meme trading and day trading activity that goes on. Some of it sophisticated, some of it not so much. All of that has reduced the entire stock market to a question of, are Fed interest rates going to keep going up or not? So in other words, they have decided that interest rates alone determine stock markets. Nothing could be further from the truth. The reason you often get, you often get them working together. You often, throughout history, have had higher interest rates with stock markets going up. And that's because the underlying cause is the same, the Main Street economy. So if the economy is strong, then you have obviously high inflation, then you have higher interest rates, but you also have higher stock prices because they're enjoying the earnings boost of a strong economy. That's just economics 101, really, or market economics 101. But what we have at the situation is sort of economics half, which is, we'll just think that interest rates determine stock market levels. Therefore, if there's going to be a deeper recession, interest rates will slow down. The interest rate hikes by the Fed will slow down, and therefore we buy stocks. It's an absurd equation in my book. There are moments in history where lower bond yields definitely do help equity markets higher, but we're in uncharted waters here, very different economic scenario. We don't have the government stimulus we used to have, and we have all sorts of problems going on around the world. We already have high inflation that isn't demand driven, it's actually supply disruption driven. I know some people out there feel that it is demand driven. That's not the case at all. There was a boost in demand because there was a lack of shipping for periods of time, but you have to put those boosts in demand in the context of what happened preceding them, which was there was no activity and therefore there was a catch-up phase. Once the catch-up phase is complete, then we're going to see even further economic downside. So I see the economic situation getting a lot worse, and where that breaks the back of the argument that if interest rates stop going up, you buy stocks, is at some point, so if interest rates stop going up, I should buy stocks, but wait a second, those companies are stopping making money. Those companies are starting to have real world problems. That's when you will see the equity market again tank, which is fall quickly. For the moment, there's a self-reinforcing spiral to the upside of more and more fund managers joining this view of a weaker bond yield, and the prospect of a severe recession means the Fed won't hike rates as aggressively as we thought, and therefore we buy stocks. I think it's a pretty little package, but be careful what's inside. For the Australian situation, RBA minutes will be out. I think they'll show some confusion. Basically, we have a central bank which still has interest rates. Remember, if people say to you the RBA is going to stop hiking or pause, think again on that as well. RBA settings at the moment, the cash rate is at 1.85%. That is a highly stimulatory to the economy level of interest rates. That used to be the old crisis low level of interest rates for the Reserve Bank. That is not restrictive. It's nowhere near neutral. Neutral's up around at the lowest 2.5, but more likely 3.25. So we can easily go to 3.5, 4.5% on the RBA cash rate before interest rates are restrictive. So if people are thinking the RBA is about to stop hiking rates at 6.1%, think again, or because inflation may be peaking in the US, or even if we saw a drop back in inflation in Australia to 5%, 4.5%, I feel the RBA would probably still be hiking interest rates. Now, it's doing so belatedly and very aggressively, and that is causing problems. I did forecast in June of 2021 that the RBA is missing the plot. It doesn't understand that inflation is not transitory. It will get much worse. The global inflation will hit our shores. I remember when Governor Lowe was saying, oh yes, there's high inflation around the world, but we won't experience it in Australia. He actually said that. And at the same time, I was saying, yes, there will be inflation here. It will get out of control because the RBA still has interest rates of 0.1% then when the economy was growing strongly. So they've really made tragic errors by the Australian people. So I'm glad to hear there is an inquiry. And I think, a bit of a revolution of the RBA is required because they've now followed up with a second great error, which is to be raising interest rates aggressively when consumers and businesses are already starting to feel the pain of a little bit of a hangover from the stimulus, big spend, big growth period, higher fuel prices, terribly higher food prices, which really hurts ordinary Australians. And on top of that, they stretched for their mortgages because everyone went to, the property bandwagon weekends and thought the property prices were going to keep going through the roof forever. Bit of a Bitcoin for property market sort of sales pitch there was in the last year or two by some people, and that was never going to be the case. Now some of these people have stretched. They're going to experience much higher interest rates much sooner than they had anticipated, particularly as Governor Lowe had promised there would be no interest rates until 2024. So this is going to be highly problematic in the area of mortgage stress. That mortgage stress will compound with higher food and energy prices, and energy prices will be going a lot higher in Australia yet still. It's really going to be squeezing consumers rather significantly throughout the second half of this year and well into next year. This is not a structure that suggests strong economic growth going forward. I've spoken before about how employment may be strong, but it really is only an indicator of the level of immigration, the lack of immigration, and the lack of temporary work visas for backpackers, travelers, temporary workers, etc. So it's not an indication of a strong economy. So as with the US is in recession. People refer to employment, but without employment, it's already got 2 negative quarters in terms of growth. So it is in recession, but a recession with a good looking employment number that doesn't really reflect the reality. So Australia could be headed down a similar path. Be wary of the possibility that Australia could actually have a recession. 2 quarters of negative growth, maybe Q4, Q1. That is a real risk. Be aware of that. So equity market buying here, hey, it's a great bandwagon. Get on it. It seems to have a lot of momentum short term. I've been getting it wrong, but I do think that eventually this equity market is going to rally out and top out and move lower in a big way, maybe another 10 to 20% fall. I think the Australian dollar is highly vulnerable to the slowdown in the Chinese economy, which is permanent, and to the loss of relationship with China, which is probably permanent as well. So Australia's trade exports have had a great boost in the catch-up phase coming out of the pandemic, which was a global phenomenon, global demand created for Australia's resources. Agriculture will remain strong. But on the mining front, I'm a little bit cautious going forward. Of course, the decline in the Australian dollar will help buffer against all of those global slowdown headwinds. So that's a good thing. So we shouldn't be complaining about a lower Australian dollar. I think a lower Australian dollar to 65 cents, maybe even 58 cents next year remains a possibility. Remember back at 77 cents, I said the Aussie was going to 70. No one believed it at the time. Then at the end of last year, my forecast for this year was we'd fall to 65. We almost got there. And the risk was we would see 58 cents next year, and I'm sticking to those forecasts. Thanks very much. I hope you have a great day. Clifford Bennett, Chief Economist, ACY Securities.